When I joined Ulster Bank, there was a very big lack of customer focus. So we needed to change that, put the customer at the heart of what we do.
He didn't need the facility. That's why it's a fraud.
And what we are dealing with is a very, very serious fraud and a very serious cover-up.
He just literally sent me one facility letter for a customer in Northern Ireland of Ulster Bank. And it literally took me 30 seconds to realise there was something fundamentally wrong with what Ulster Bank had done for that customer. Because on that facility letter, it had set out, here is a fixed rate loan for that customer, fixed rate loan. But in the same facility letter, it was talking about a derivative with a credit line against that derivative. And I'm an expert. The one thing I absolutely know is it's not the customer that needed the derivative, it's the bank that needed the derivative.
So what happens is the bank will actually lend you money when you take out the swap, except they just don't tell you about it. Yeah, and that is margin credit or what I often refer to as hidden credit lines. Now, it's an FCA rule that if you're selling an investment and that there are risks on that investment, leverage risks like there are with derivatives, then you must describe to the customer the type of risks that are specific to that investment. This is in the FCA's handbook in what's called COBS, it's the Conduct of Business Sourcebook, Rules 14.3. This, in simple terms, is a bit like somebody going into a bookmaker's and doing a spread bet where there's a leveraged win or loss. And effectively, the bookmaker's going to want some kind of cash or account in place to cover those potential losses. It's the same with swaps, but those have to be disclosed. Now, what we had in Ulster Bank, in theory, are fixed rate loans. That's what people were told. Now, the difference between the fixed rate loan and the swap, and Ian's really set out most of that, is that the swap is a standalone trade that's done separate to the loan, whereas in a fixed rate loan, you are fixing the rate as part of the whole loan contract. Key issue here, in the fixed rate loan, the bank takes the credit risk. So if you fix a loan at 6% and it's for 10 years, your only risk on that, if rates start moving down, is if you need to break the loan. Otherwise, you just pay your 6% per annum, and at the end of the 10 years, that ends. On a swap, however, you carry the credit risk. So you'll be given an initial credit line covering any potential initial forecast losses, and that will also include the commission the banks take. But that can vary massively depending on where interest rates go. The ongoing risk of rate fluctuation leads to that credit risk for the individual client. You don't have that in the fixed rate loan, as I've said. There are standalone break costs. So you could carry on paying a loan where there's been a swap protecting that loan in theory, but you could break the swap trade. You may have to pay a break cost on it, but it wouldn't break the loan. However, on a fixed rate loan, you simply pay an additional penalty if you break the loan. So a swap is something called a contract for difference. So that's a form of investment, and it's a regulated product. The fixed rate loan, however, is deemed to be a commercial loan. It's not an investment and therefore not a regulated product. But a key thing, and Ian said this previously, and this is a big driver here, on the swap, the bank and the salespeople and the bank managers can all take their profits and commissions up front.
And then they had some wonderful wording. And again, this is highly, highly irregular. The facility letter talked about breakage costs arising as a result of the termination by the borrower, either before or after the execution of such an agreement, shall be for the account of the borrower. Basically, they were telling the customer he was on the hook for their interest rate swap before he'd even signed his loan agreement, which again, you can't be on the hook legally for something before you signed it. Highly irregular. That's the motivation for the bank to book this large day one profit, so that they can book a profit at the customer's expense from day one. Again, this is a simple example. I've stylized it to keep the numbers simple. And we imagine they've got a loan, a 5-year loan. So you don't care whether LIBOR goes up or down if you fixed your payments. You weren't very sophisticated. You didn't have a Bloomberg terminal. You couldn't police the bank who provided the swap to you. So you suddenly find out years later that actually, although you were quoted 5%, the market rate at that time was 4.5%. Ah, that's strange, isn't it? Why didn't I get the market rate? Why did I? Well, because you didn't know what you were doing. The bank took advantage of you, and essentially that's what's happened big time in all of these structures. And very simply, if you cut through all of this crap on derivatives and some of the fixed rates, loan sales and stuff like that, the whole motivation for all of such sales was this upfront taking of profits. I thought I'd use some numbers just to illustrate that everything in banking can be turned into numbers. And of course, it's numbers that really matter. So again, just going back to the stylized example I had on the first slide, 5-year swap, hidden margin of 50 basis point. I've added this other fact, 10 million notional. It could be a million. It doesn't matter. I've chosen 10 million. What I can prove to you just with a calculator is the fair value on day one to the bank from that 10 million notional swap is 221,655. I told you 2.22 because I was rounding it. I didn't round for these numbers. I did them to the nearest pound. 221,655. That's a lot of money that the bank has made from that derivative sale by adding 50 basis point to it for 5 years. But now let's look at interest rates coming down. And this isn't too dramatic. This is rate. We talked about the 5-year market rate was 4.5. Here I've made it 1 year later. The 4-year market rate is now just 3%. So this is a move down, but it's not too dramatic a move. No, the actual move in 2008 was much bigger and much quicker, but I just wanted to illustrate it. And the fair value has gone from 221,000 to 748,000. And remember, this is the amount the customer would have to pay if the swap is torn up or cancelled that day.
So what happened in 2008 and 9, people who had potentially smallish liabilities initially, rates started dropping, and the difference between, say, the 5.5% they might have fixed at initially and they then 3 to 1.5% created huge additional liabilities. And this is what sent the majority of customers into specialist support units like GRG. And I've quoted it before, but a whistleblower I took to see Sir Norman Lamb literally said to Sir Norman, every customer I send to GRG for a loan to value breach was because of the swap credit lines. We weren't allowed to tell the customer this was the cause. We would have to find another breach or say get an undervaluation on their property to manufacture a security breach. That is what they've been hiding, because what they're trying to do with these products is they're trying to say your only real risk is if you break them. Now, that's true if, like Ian said, if you buy a fixed rate loan, as long as you pay your fix, that should be the only risk you take. However, with these products, you have or carry that additional credit risk. So your risk on a daily basis can be much, much higher than that break cost risk. So it's two entirely different risks. I mean, they do interact with each other, but the biggest risk is this undisclosed credit. And they've got away for 10 years by trying to say this is not relevant. But it's this undisclosed credit that put most customers, certainly in GRG and in Ulster Bank, into GRG and into insolvency.
This is clearly damaged a whole cohort of clients in Northern Ireland, because the facility letters Steve had shown me were in Northern Ireland. But I was absolutely certain that exactly the same arrangement would exist for a cohort of customers in the Republic of Ireland, because the way this had been set up was using the trading desk in Dublin that Ulster Bank had.
Why was it done? Well, just a simple example of, and I've rounded these figures up, but these are some of the cases that I've worked on. Swap 2.1 million swap, 5-year term, taken out in November 07, initial contingent liability 114. We have on file the liability, this credit risk going up to 188,000. It would have gone higher, but I can only work to the files I've got because the bank withholds a lot of the documents when you apply for the files. The commission on that sale was £32,000. Yeah, so that's a day one commission on that deal, on a 5-year deal, on not too big a loan. Look at the next one, 2 million loan over 10 years. Initial liability, so that's the credit risk not disclosed to the client, 267,000. So they think they borrowed 2 million. They borrowed 2,267,000. That, when rates dropped, went up to 550,000. That's at the point where they're told they're at 92% loan to value and sent to GRG. The profit, day one profit on that sale was 47,000. Look at the next one, a bigger deal here, 11.5 million over 10 years. Initial contingent liability, 1 million. That goes up to, I suspect, higher than this, but we know at least over 3 million. The commission on that deal, day one commission or profit, was £180,000 for the bank. Undisclosed. All of these commissions undisclosed. All of them being able to be paid out because they put credit lines against you that they haven't told you about to cover these profits. Look at the final one, 5.2 million. That's the same one I was talking about previously. The contingent liability started at 1.45. It would have gone above 3.8, but I've got evidence of it at 3.8. The actual commission on that sale, 25-year sale to the bank, was 335,000 on day one, undisclosed. And there are still people in Ireland today who are fighting to save their homes and their businesses and their assets because of this fraud that remains covered up.